We said earlier the loan pricing is transaction based. What it means is every transaction has to be priced according to the kind of risk involved, which is coming out of the risk premium. Now, what are the other components of the cost of or the when you are saying or calculating a base rate or loan pricing? You know that basically you need the resources when we want to deploy funds, whether it is loan or investment. So one of the important input for a loan pricing is the cost of deployable deposits. As we know that when we accept a deposit of 100, part of amount goes in SLR and CRR. So what remains only can be deployed. For a deposit of 100, there is a CRR which say 4% and SLR which is 23. So what remains for deployment is only 73. So basically one of the input when you are considering the loan pricing is the cost of deployable deposits. In this case, the deployable deposits are 73. We need to adjust for the CRR and SLR depending on what percentages are there. It's a variable depending on the RBI prescribing periodically CRR and SLR. So one of the important factor which goes is the deployable funds. It could be borrowed funds, it could be deposits. Now next is the operating expenses, because all this activity will involve some operations. So basically one of the other input which goes into the loan pricing is the operating expenses. What is risk premium? And how do you measure risk premium? Risk premium can be measured by understanding the risk with a particular portfolio. So what is portfolio? Portfolio will have some uniform kind of characteristics. Suppose we can say that housing loan, all housing loans can be put in a particular portfolio. All corporate loans can be put in a portfolio. Further, the corporate loans can further be split into various kind of industries. So we can have a portfolio where you have a textile industry portfolio, you have a steel industry portfolio, you have a cement industry portfolio. Basically all this, and one of the important measure of risk premium comes out of the what is known as the credit rating of the borrower. We know that the banks rate the borrowers and there are external agencies who rate the borrowers. What does the risk rating tells you? Risk rating will tell you about the kind of risk which it's a measure of credit risk. When we lend to a customer who is AAA and we lend to a customer who is B, there is a big difference in the kind of risk we are taking, because historically it is proved that the higher rated borrowers, the default rate is less. When we say the default rate is less, there is less likelihood of the bank incurring losses when they lend it to the AAA rated customers. So one of the measure of risk premium is using the credit ratings. So there are different methodologies. We will not go into the details. And basically in a portfolio level, this is about the individual account level. At the portfolio level also, the banks can have some measure of knowing what are the likely kind of the losses the bank could incur by lending to a particular sector. So that basically comes out of the portfolio analysis. Now the capital charge. Capital charge, we know that if you specifically talk about the banking sector, there is a minimum capital adequacy ratio which is stipulated by the regulators, and the bank need to maintain a capital to absorb any unanticipated losses. Now the capital charge is basically the cost of capital. So banks need to maintain capital to support its asset as per the regulators' requirements. So basically what goes into the risk pricing is the cost of capital required to support that kind of an activity. Suppose we say that a particular, there is a stipulation of 9% capital adequacy. So if I am lending 100, so basically I need to maintain 9 rupees capital for that exposure. So the cost of raising this 9 rupees is what is known as capital charge. Though banks can raise capital by way of equity, they can also raise by of borrowed funds depending on the regulator's prescription. So all this is added to the loan pricing. So the loan pricing basically comprises of cost of deployable funds, operating expenses, risk premium which varies from asset to asset, and the capital charge which is required to be maintained as per the regulatory requirements. Now the next part, important price, is having priced the risk. Now we have to monitor the risk and control it. So we have done some kind of risk mitigation by putting all the expected losses in the risk pricing. But now how do you analyze or do a portfolio analysis to see whether all our presumptions about the risk premium has gone correctly? That basically comes out of what is known as the risk adjusted return on capital. Basically any organization, it is not only the gross returns which is important. Basically they are more concerned whether my returns are enough considering the kind of risk I am taking. So that is where this the risk adjusted return becomes important, and it is always an objective of any business to enhance its risk adjusted return on capital. Now when we are talking about risk monitoring, when I know that I have decided on the risk limit, setting the risk limits becomes very, very important to control the risk. It's like putting the speed breakers on the road, or freezing the maximum speed at which a vehicle can be driven. This is some of the practices which some of the transport state level transport corporations were doing for their vehicles. So like that in the bank, normally we can set the risk limit. What are the risk limits? It could be kind of an exposure, or in case of an foreign exchange position, it could be a limit, overnight limit, which the bank can keep open, which is exposed to the exchange rates. Or it could be the kind of the interest rate mismatches. We have seen that this the maturity mismatches creates the interest rate risk for the bank. So bank can also set up some kind of risk limits for various mismatches. Having said that, the next thing is somebody needs to monitor whether the bank is following the risk limits, or is there any exceeding which is happening. The moment somebody is exceeding the limit, we know that the risk and rewards are proportional. Somebody who is taking extra risk, though he is likely to earn more money, at the same time he is exposing banks to a high risk, and there is a possibility of incurring higher losses. And the risk management is more about curtailing the kind of extreme losses. And how do you monitor the and control the risk? Like for any performance monitoring and control, one of the important things which is required is the management information system, which is very key to any control exercise. So there has to be a proper information system, and somebody who is not involved in the business activity has to be monitoring and controlling this. This normally is done at the controlling officers level in case of banks. One of the important thing about risk management, even the regulators have been highlighting about the independency of risk management function. This is very, very critical. The risk origination and the monitoring should not happen at the same places. That's very risky for the business. So somebody who is not associated with the business, who doesn't have the business targets, who doesn't have the profit targets should be ideally the one who should be doing the risk management function in the bank. This goes up to the board level. The subcommittee of the board, we have seen, risk management of the committee is also most of the time is independent of any business decisions. In a dynamic situation, it is very important that we need to what is known as a risk profiling of the bank. What is risk profiling of the bank? To capture in one place all kind of activities and all kind of risk the bank is exposed, and just see how the risk have moved from one period to the next. That is what basically is a periodic risk profiling of the bank. What does it tell the bank? It tells where the risks are, whether the risk is on the rise or whether it is increasing, decreasing, or what is the likely impact of this additional business which the bank has done in the previous quarter. So most of the in the banking today, it depends on the kind of activity you are doing. You can risk profile a particular kind of a portfolio more frequently if you feel that that's the one which is giving more risk to the bank. And after doing the risk profiling, the important thing is I need to assess the capital requirements. So as we said, the business needs capital to support business. The risk profiling will tell you, because we ultimately are targeting the risk adjusted return on capital. So I need to assess my capital correctly depending on the kind of risk I am taking. Higher the risk, more the capital again. So the estimation of the capital needs comes out of the risk profiling of my business. Now the risk mitigation. When you know that there are risks, and we also know that risk cannot be totally eliminated. If we eliminate all the risk, there is no profit. That is how it is. There is no safe business, without attracting any capital in the current scenario. So risk probably can only be transferred. The best example of transfer of risk is the insurance. The vehicle insurance, fire insurance, or any insurance you talk about, it's basically what we are doing is, since these are some of the risks which cannot be avoided, cannot be eliminated, but however can be transferred. So what is the impact of the risk mitigation? Suppose I am giving a loan, clean loan, and say 100 rupees. If I am taking a cash collateral of 50, the remaining risk is 100 minus 50, that is only 50. That is the impact of the collateral. To be very, very, in a layman's language, to explain the risk mitigation is it reduces the risk on the original exposure to the extent of the collateral I am having. But the important part we have to understand is, when I am saying that I am mitigating a risk, does it reduces my profit potential as well? Yes, it does cap your upward profit potential. We take a very simple example. Suppose I book a forward contract for purchase of dollars, and say at 63 rupees, and this is March 14 delivery. Suppose in March 14 actual rate is 64. Since I have already purchased a contract at the rate of 63, now I cannot get the benefit of this 64. So effectively I have capped my profit at 63. I am not going to get that additional 1 rupee because I have trying to mitigate my risk. What was the risk? I was worried that the dollar rupee may go down below 63, but actually it has not gone below 63, but it has gone upwards. But I will not get that additional 1 rupee because I use that risk mitigation to restrict my losses. Now, as a part of risk mitigation, we must also understand the counterparty risk. And what is counterparty risk? When you had done a deal, maybe a purchase of some instrument, financial instrument, with some counterparty who can be a bank or non-bank. Basically, there is something called what is known as a settlement risk. So it is a sort of a credit risk when the one party completes his obligation under the contract. Suppose you were to deliver a security, you have delivered the security, but you have not received the consideration. So this basically is counterparty risk. And how it can be mitigated? Most of this counterparty risk comes in case of deals which are over the counter deals. So this is basically one bank does a deal with other bank, or one corporate does a deal with the bank on a one-to-one basis. And the best way to mitigate this is doing the deals through what are known as the central counterparties, what are known as the exchange traded contracts. So the ETC contracts will not have this counterparty risk. And one of the way you reduce the risk is, or mitigate the risk rather, is by diversification. What is meant by diversification? Diversification is by, if you are lending to different kind of borrowers, different kind of industries, to lend in different geographies, so that your risk doesn't remain concentrated. So that is one way of reducing or mitigating the risk through diversification. Because when you lend to 5 different customers, say 1 crore each, and lend to one customer 5 crores, the risk of the activity of lending 5 crores to one customer is more risky, because there is no, in the probability also, probability wise, 5 people defaulting at the same time is very less. So that is how you get the benefit of diversification in case of through risk mitigation. And the portfolio risk is basically the kind of portfolio we have discussed earlier, that the banks does lend to different kind of activities and different kind of products. So each kind of a product or each kind of a segment can be considered as a portfolio, and we need to manage those portfolio risk in a different way. So that is at a portfolio level, whatever mitigation we have to do. Now that is what we had discussed so far. We let us see check our progress. The first question is, what is true about risk? There are 4 answers. The first answer is risk and uncertainty are synonymous. This we have seen that risk and uncertainty are non-synonymous. This is not the correct answer. Not all uncertainties are risky. Risk and reward are not related. This again is not correct. We have seen that risk and reward are related. Risk is associated with only financial transaction. This is not true. Risk is associated with manufacturing, service, or any other kind of activity. Even if you are walking on the road, there is a risk. So the correct answer is, not all uncertainties are risky, because the uncertainties have positive as well as negative impact. So so not all uncertainties are risky. Only the uncertainties which have a negative outcome are risky. Now, why capital is essential for any business? Capital is cheaper and therefore business profit increases. This is not correct. We have seen that capital is expensive and all the business need capital. Capital acts as a cushion to absorb business loss. This is what we have seen. Capital, in case of loan pricing, we have seen that capital acts as a cushion. So this is the correct answer. It increases the status of the business owner. This is not true. No business can be started without capital. This is also not true. So the correct answer is, capital acts as a cushion to absorb business losses. Investment in government securities are made because they offer higher rate of interest. This is not correct. Because they are always issued for longer tenure. It is not true because there are other bonds which are issued for longer tenure also, and that is, these two are not the reasons for investing in the government securities, because they have minimum counterparty risk. So this we saw that we had discussed, there is a counterparty risk when counterparty risk is nothing but the credit risk. The credit risk is less when you are investing in government securities. So this is one of the reasons why government securities are preferred as investments. So this is the correct answer, because government securities can be encashed before maturity. This is also not true. Now, what is not considered for loan pricing? We have seen that operating expenses, loan probabilities, that means the loan going default or the NPA going up, cost of deposits, these are all the inputs for the loan pricing. Loss incurred by the bank in equity trading is a trading loss and it cannot be added to the loan pricing. So the correct answer is loss incurred by the bank in equity trading, which is not part of the loan pricing. So that brings us to the end of the first unit.